Welcome to another edition of our Transportation Insights. My name is Patrick Berglund, and I'm joined here today by Adrian. Adrian, would you care to give a short intro to the audience and tell everybody who you are?
Sure, thanks, Patrick. I'm Adrian Tolson. I am a director in Blue Insight. Blue Insight's a consultancy business focused on shipping and with a fair amount of focus on the marine fuel sector as well. My own background actually is out of the marine fuel industry. I originally spent about 30 plus years in that industry, up and down the supply chain, managing different companies, et cetera, et cetera. But for the last 5 years, I've run a consultancy business, consulted everywhere from financial companies to shipping companies to suppliers to commodity traders. So I follow that supply chain, follow the markets very closely, and can probably sort of help to get through some of the questions that we might have today, or you might have today, Patrick.
Fantastic. Listen, I'm super thankful for you joining me today. I thought since we last met in person was actually at our customer summit, and you did an excellent display there and gave a lot of your insight and shared a lot of your knowledge about the IMO 2020 situation that we were heading into, and I think that was on the top of mind for an entire industry, right? And we had these interesting debates about, is it really cost driving the rates for the customers, and what are we looking at for really in terms of cost increases in 2020, and a lot of uncertainty. Now, nobody anticipated what we see today in today's market, and maybe it would be a good idea if you could just start off on the purely basics. What's happening with oil prices today? Can you just give your high level sort of,
sure.
bit of that?
I mean, obviously, forget the IMO thing. Let's just talk about sort of crude oil, because that's where it all starts, right? Obviously, part of the initial impact of coronavirus was the fact that Chinese demand for crude oil and products were going down around the world, and so that was starting to create some concerns over the price of crude oil. It was starting to look weaker. There was an OPEC meeting in which the Saudis tried to get some sort of agreement, and then they went to the Russians, and the Russians wouldn't agree with it. And whether or not you believe the Saudis and the Russians are conspiring together to destroy the US growth in crude oil production, or whether you believe that the Russians just simply walked out of there for their own reasons, the point is that even before we got into the grips of this coronavirus sort of concern, the pandemic, as well as just the impact of it, we were already looking at a very weak crude oil market. And so we've got two things going on. You've got almost a crude price war going on at the same time as you've got a pandemic you're trying to deal with. The two are all pushed into one. I mean, it's not like the Saudis and the Russians could get together now and announce some massive cutback that would make any difference, because now demand destruction has got to a different level. And I think that's the key element of this, is that we're starting to see huge impacts, obviously, in demand for crude oil. I mean, huge impacts in demand for products, and that's starting to has collapsed the whole structure today. I mean, as we speak right now, crude is barely above $20 a barrel. I mean, very, very low prices. And also the products, all products are coming down quite dramatically too. And this has had an impact in the fuel for ship area, the fuel for ships, and marine fuel and bunkers. It's had obviously an impact because what happens with one sector of crude oil and products that come out of crude will have an impact on the other products that are produced for bunker fuel. So we're starting to see it interesting. I'll give you an example of that. For example, the drop in gasoline demand is, on surface has no impact on our world, but then you realize that if you remember conversations during that pre-IMO period, how a lot of refineries are going to look at whether or not they produced low sulfur fuel oil or whether they produced gasoline, and there was a direct choice at the refineries. Suddenly, with gasoline demand almost non-existent, nobody's nobody's driving anywhere, right? Except an emergency level. So gasoline demand has dropped. That means that low sulfur fuel oil would naturally be much more attractive to produce and put into the market. So those impacts are starting to be felt as well. So a lot of changes going on, and that's before we get to the IMO issues. I'm going to give you a little rerun on what happened with IMO. Had in fact already started to unravel a bit prior to this, and that wasn't due to demand. It was that we got through the transition. We saw a spike in prices, very high levels, big spreads between low sulfur fuel oil and high sulfur fuel oil, and that was all due to the panic, sort of the transitional panic when there were shortages, which were sort of anticipated. We started to see those spreads narrow, particularly this famous spread between high sulfur fuel oil and low sulfur fuel, and that was coming in anyway, even prior to this happening. And part of that was that wasn't so much that low sulfur fuel oil was particularly cheap. I mean, people had found ways to produce it, and there was more of it around than perhaps any of us thought. But also the fact is high sulfur fuel oil was not dropping as fast as everybody anticipated it was. And some of that was simply that was a weird permutation in the market. A lot of that product was getting put into cokers. More of high sulfur fuel going into cokers was being re-refined, if you like, in some fashion or other, used at the refinery. And so that kind of took a lot of that high sulfur demand away from the market at a very critical time. So we never saw that. We never really, that famous sort of $200–$250 spread that everybody was thinking we'd have between high sulfur fuel and VLSFO never really materialized as we went through late second half of January. It just wasn't there. And now, of course, it's dropped even more. So.
Yeah, but and how? What does this mean in terms of all those vessels being retrofitted or equipped with scrubbers? All these future order book that has scrubbers already planned to be installed on them. What does this mean for the carriers, the ones who decided to go for them, and those who didn't, and so forth?
Well, I mean, obviously, it depends how you look at the investment. I mean, the exciting economics of scrubber investment was if you looked at the figures that we all had prior to IMO 2020 actually happening and the coronavirus outbreak, everybody thought, well, we're going to have this 200 to 300 spread differential between these two products. Therefore, these investments will pay themselves off in a year or a year and a half or something like that. But that's all changed, right? Because if you've now reduced that spread, now that spread is now dropped. Depends on where you are in the world, but if you go to some locations now, it's as low as $60, $70, $80 a ton between those products. So we're a third. You basically multiply that payback time by three, right? So suddenly those economics are not very attractive. Now, if you've already put the scrubber on board, you've already invested in that, you've already made that commitment. It just means you're going to have, to get the return, you may have that scrubber on board your ship at today's prices, and we assume today's prices just hold, which is probably not the right thing to assume, but at today's prices, you can go on for 4 or 5 years. If you still have a decision or installation to take place to do, then you're probably not going to do it. And you're not going to do it for two reasons. One, you're not going to do it for, well, that's working at home.
That's the new normal, I think, with home offices and also homeschooling.
You probably staged that, Patrick. Come on, that was a stage.
I promise not. I heard them coming and I thought, like, oh man, this is going to interrupt him. I apologize, Adrian. We didn't mean to take you off your line of thinking.
I think you look at that, you see that the spread has narrowed on scrubbers, and so that makes them less attractive. It means that I think there's two reasons why it becomes less attractive. One is the payback is a lot longer, and two, who wants to make a capital investment at this moment?
Yeah.
So you saw, I think, Wallenius Wilhelmsen pulling out of their scrubber investments. Obviously, their sector is the car carrier sector and ro-ro sectors are a huge mess, right? But so you can see these people doing that because it just doesn't make sense for them to spend money until they know what, it's more about survival now for many shipping companies than actually dealing with the environmental issues at the moment, right?
Yeah, and it's interesting then, even like back in 2019, we talked about how this is not being picked up as a huge environmental impact, and we should all sort of celebrate the transition. Now, with the current market, isn't there like responsibility that they have in terms of continue evaluating their options here from the carrier side, or less traffic? What do you think here from an environmental point of view? Is there anything positive we can take from this?
I think so. I mean, in some ways, yeah. I mean, I think obviously people's focus are not going to be. I mean, even is it Friday? I think the British government, or whatever they call the Coast Guard, announced they're not going to do any checks at the moment about IMO 2020 compliance. I mean, because they're swamped with other things, right? Trying to make sure that people don't, cannot coming in with virus and all those things. So there's a lot of issues going on. So I think at this point in time, obviously people are not focused on this. So, but I think so. The short term, yeah, you could say people are going to be somewhat lax. But I think one of the interesting things I think comes out, this is just a very big picture thing, is I think that people do ultimately, come out of this. We come out of this in whatever it is, 3, 4, 5, 6 months, whatever it is, and everybody's much more focused on public health, right? And there you have, and so suddenly, right to start with, we're all worried about epidemics, but then we're going to be worried about emissions, about global warming, and the focus is there. And I have a feeling this gives more impetus to that ultimately as a result of this event, although it's obviously unrelated to it.
But from a carrier point of view, Adrian, what do you think about the entire cost picture being reduced for them with the oil prices? Do you think it's something they benefit from, or have they locked themselves into higher prices? Anything to share in terms of what? Because I'm trying to sort of think from a shipper point of view, right? How is this as the market recovers, and assuming that oil prices remain quite low? I mean, it will probably take some time before they catch up to the level it sort of dropped from anyhow. So what would one anticipate as one go out of this crisis at some point? Would it be low fuel cost equal low transportation rates, or will it be a V-shaped recovery? So there will be so much cargo that it is supposed to move that is going to be expensive to get your goods moved. How will this look from a shipper point of view, you think, and then from a carrier point of view? Is there like a blessing here with this collapsed oil price relative to their financials? And that, I guess that's the two sides I'm interested in, the carrier side and the shipper side. How does it play out, do you think, for these players?
Yeah, I mean, certainly, obviously, cost of operations is considerably less, right, in terms of fuel, and but obviously that doesn't necessarily mean you've got cargo to move. And I think it's too early to really speculate on what's going to happen to international trade and certainly container trades, right? We know that, I mean, there is obviously a need for international trade, and it continues to this day. And there are ships coming into New York with containers on board, or into Rotterdam with containers on board. I mean, it's happening, right? So it's not like that's died altogether. And the container rates have been very attractive. You've heard some reports about particularly high container rates. I think one of the things I see being issues, and this is something that that the shippers have sort of had perspective on board, I see is the supply chains being stretched here, because as different countries around the world have more and more problems, it doesn't seem, just because we're living just in time nowadays and everything is, the supply chain is very tight. It just seems to me that there's a lot more issues coming down the road as we go, that will restrain international trade from returning, and therefore restrain the activity that the container companies can have. So I think no one's going into a sharp V like that, right? They're all going into, I don't know if it's the U, or if it's one of these sort of weird sort of L's with sort of turbine comes up towards the end. But I think it's a bit tougher than we tend to think, because I think the supply chain issue, I mean, just this is anecdotal, but just article read, about trying to manufacture ventilators, which everybody's talking about, ventilators, right? Trying to manufacture ventilators. That one of the major leading manufacturers of ventilators in the United States indicate that they currently make ventilators where they get parts from 17 different countries. Now, trying to source all 17 parts and even find alternatives in this situation at this moment, finding people who can work and get those and are actually manufacturing and have factories operating at full speed, it's a huge task right now.
Yeah, I think sorry, you're absolutely right. And I think even from like contingency planning, it's going to be super interesting to see what comes out of this after post crisis, right? And see how companies do try to mitigate the risk, and if this were to ever happen again in our lifetime. which, I mean, the probability is actually there, all things
Sure.
considered. But Adrian, time is flying. And I promise to only take you for 15 minutes, so I want to be respectful for that. What's top of mind for you in terms of your concerns or thinking about shipping lines these days relative to oil prices? What do you keep an extra eye on, or what are you concerned about, or what is just your number one priority when you think about these players?
I mean, everybody's concerned about counterparty risk, the whole industry. And I think everybody's concerned about it. Certainly, the oil industry and the bunkering industry is concerned about, which of these companies can we still sell to? Because, and you made a point earlier on, did these guys buy on fixed prices? We don't think many of the big container companies bought on fixed prices. They usually buy on floaters, so with hedging, so they should be okay. But you never know, you never quite know. Or did they not have did they have some hedging tool in place that is actually hurting them in this sort of market? So everybody in our industry is very worried about counterparty risk. Obviously, we know shipping companies' debt balance sheets are enormously, debt on the balance sheet is not going to go down in value. We know, we've all heard the CMA rumors, right? That's all out there. So I think there has to be genuine concern on that. For me, that's the biggest thing I think in our industry right now is, I dealt in my career, and I didn't bring that in I dealt with a company that collapse in OW bunkers, which is a famous industry collapse, that dealt in a similar market crash, not as intense as this, but the company collapsed because the mistakes were made sort of in the hedging processes within this company, and it went out of business very quickly. So is there one or two or something there out there on either side of the supply chain, whether it's a supplier, whether it's a ship owner? Those things are what are worrying the industry right now, and that's taking a lot of the credit out of the industry. So people, a number of the major oil companies are demanding letters of credit, cash payments for bunkers, when before they were happy to give extended credit terms of 30 days or 45 days or whatever. So there's a lot of uncertainty right now in that marketplace. So this is going to hurt too. Although prices are cheaper, you still ship owners still need cash flow. They still need working capital. If that working capital is pulled away from them at this time, it could be very catastrophic. The only thing that's good for shipping is that it's a strategic business, right?
Yeah.
And most governments still have an affinity to most shipping lines. So there is a willingness to support those lines, whether it's logical or not. And so you would think that they would, if you're doing a bailout package or a rescue package, shipping companies would probably be on the list there too, right? So that's positive.
That's a great point to wrap it up for this time, Adrian. We next time we schedule more time, but I'd love to get you back on. It's such a pleasure talking to you. Thanks a lot for sharing, and thanks everybody for listening. On a final reminder here for all our customers, please go online and continue the conversations there. Ask us anything you might be curious about, and we will dig into our network in order to provide the answers to you. Our customer discussion forum is available at community.zenata.com, and you can log in with your normal credentials. Again, Adrian, thanks a lot, and I'll look forward to chatting with you again soon.
Great, Patrick. Thanks. Take care.